This is Scott Becker with the Becker Private Equity Podcast. We've got today one of our regular guests he's a brilliant sort of thinker on what's happening in the private equity world, the economy as a whole. He's a director of research at RSM, Matt Wolf, just a brilliant person. We've got him mobile today, so we're trying to make sure his sound is okay, but he's brilliant, so it's worth having him wherever he is. Matt, what are some of the things, tell us one of the issues that you're watching closely in the private equity world today, and then I'll ask you a follow-up question about something I'm seeing, which it seems like every fund is raising money again. It seems like we're getting requests for funds to raise money constantly right now, but funds are also slow in putting money to work. So it seems like a very complex situation where the engine of fundraising keeps on going, even if private equity funds, as they curry up all these commitments, aren't as quickly putting that money to work. So what are you seeing out there? What's one of the issues you're watching? Then I want to ask you about this fundraising issue.
Yeah, no, thanks, Scott. It's a great issue too. I mean, and we're looking, as we look at the overall sort of middle market deal-making environment, one thing that we continue to monitor is the popularity of private credit and the incredible inflows into this asset class and what that means for overall deal-making. And one thing that's really we're watching with respect to monetary policy are the spreads between private credit, so for example, like a term loan and treasury yields, and what that might look like in the future, right? All else equal, as money flows into private credit, that will compress those yields or at least relieve a little bit of pressure on yields to continue to increase. But, we're approaching, maybe we're far away, maybe we're close to this sort of upper bound on just how much debt the middle market can service, middle market companies can service, because even with all the money flowing into private credit, there's only so much cash flow to go around to service this debt that is now much more expensive than it was 2 years ago. So we continue to watch these spreads. And one thing that we expect, and we'll see how right we are or not over the coming months and years, is as the Fed pauses its rate hike campaign and potentially even begins to cut rates, what does that do for private credit? Will we see such fierce competition for deals that those spreads will continue to compress, maybe even come down a little bit, and we'll get a little bit of relief on these term loan yields that we're seeing in the private equity, private credit deal-making environment? Will that help then encourage more deal-making? What will that look like, especially given this sort of unprecedented influx of money into not only private equity, but certainly into private credit as well? So continuing to watch that spread and the reaction function from monetary policy.
Let me ask you two follow-up questions on the private debt issue. So the first thing is, I saw a stat that corporate defaults in the United States had hit their highest level in 15 years this past August, with 16 companies defaulting of a certain size. And that's a scary thought. And that's obviously people with lots of debt, and then rates getting much higher, and their own businesses getting softer. So you got a combination of factors that lead to more corporate defaults. But the most corporate defaults in 15 years is a scary thought. As the world continues to get flooded with debt, you said it exactly. There's only so much cash flow to go around. I see more and more companies that have cash flow issues, not because their business isn't fundamentally solid, but because they have so much debt in that business that all of a sudden they've got cash flow challenges. And I don't care how much you talk about EBITDA, if you have cash flow challenges, you have trouble. How much of that are you seeing concerned about corporate debt, corporate defaults? And then the next issue is, I did see some of the big banks. Jamie Dimon commented this week about how private credit isn't required to hold the same kind of reserves and capital that big banks are, and that's an unfair advantage for private credit and sort of an arbitrage in the market or a problem in the market. So any thoughts on those two issues?
Yeah, it's a great question. So the first one about the corporate defaults, I mean, we're experiencing once in a generation, perhaps, change in the credit cycle. And so we're going from this sort of unprecedented zero interest rate policy into something a little more typical historically, but this type of transition is very uncommon. And unfortunately, some borrowers, some lenders have been caught flat-footed by that, right? They were levered in such a way that made sense when the Fed funds rate upper bound was 25 basis points. It does not make sense when it's 525 basis points. And that is just an unfortunate position that many borrowers have found themselves in, and the lenders are now feeling the impact of that as well. And that will take time to shake out, and that is what happens when the credit cycle turns over. So I think it's definitely something to watch and be cognizant of, but it's perhaps unsurprising. With respect to the sort of leverage requirements of private credit compared to traditional lenders, I think it's also important to understand that they serve different roles in the capital markets. They're not necessarily interchangeable, and we're seeing that kind of shake out as well in the M&A market, right? When money was really cheap and low, you had traditional lenders participating in syndicated loans alongside some of these private credit vehicles. And now that the credit cycle has changed, participants are taking their more specialized approaches within that cycle. And maybe that's the way that it should work. I don't really have a viewpoint one way or another, but I think, this will work itself out. And certainly the regulators are looking at this, and we have very astute and keen regulators who are monitoring the situation. But, perhaps this is just the way it should be. JP Morgan makes its types of loans, private credit firms make their types of loans, and there's less overlap going forward than there was in the previous cycle.
Yeah, no, that's a fascinating perspective, and thank you. Let me ask you about the next question. The next question is this. I tend to be seeing more and more funds raising funds again, at the same time that they've not really used up a lot of their capital commitments currently. Is that because a lot of funds see potential opportunities to go after assets that are great businesses but in financial trouble? Or what's driving, it seems like, an explosive growth in attempting to raise funds at a time when there's so many commitments still out there? Any thoughts there?
Yeah, it is an interesting dynamic, and I think each firm is approaching it a little differently. And I think sometimes too, depending again on the firm and the fund, some of these new funds that are coming up, they have different investors and they have different objectives. They might even have different fee arrangements than some of the prior funds with prior commitments. And I think also firms are being cognizant of, how long are some of their late vintage funds, right? I mean, they perhaps even returning commitments for older funds. Maybe down the road we might see some of that. But I think a lot of this is, again, a reaction to the change in the credit cycle and trying to capture some market share in this new rate environment.
I mean, a fascinating set of subjects that are out there. Again, Matt Wolf, director, brilliant thinker at RSM. Thank you so much for joining us today on the Becker Private Equity Podcast. Thank you very much.
Thank you, Scott.